Good morning. Sorry for the technical interruption. We just having a bit of feedback with our presentation. Bear with us as we get that sorted out. We are going to start in a few minutes. What we are discussing are the 2021-2022 tax amendments. These were passed into law and they're effective 1st July 2021 and they'll run for one financial year up to 30th June 2020. We have a couple of tax amendments that we've made. We have a very diverse team that is going to help clarify and give more information on the amendments for all our benefit. Let us all ask questions, let's pay attention, and let us also try to focus on the matter at hand. What we are discussing are the tax amendments. Let us try and restrict our questions and comments to that. I will have time after each presentation to go through the questions and give feedback where we can. In the event that you need further guidance, you'll be able to reach us on our personal emails. My name is Brian Mugasha. I will introduce the team with me. On my immediate right is Mr. Solomon Mukundo, who works in business policy. We have Ms. Fiona Akulo, who works in our legal department, and Salongo Frederick Kaliango. This is the team of experts that is going to guide this discussion. I will moderate and ensure that we keep time and also answer as many questions as we can possibly do so with the time that we've given. So without wasting any further time, we're going to go into our first tax amendment, which will be done by Mr. Solomon Mukundo. That is the Income Tax Act.
Yes. Good morning. Again, the Income Tax Amendment Act 2021 introduced a number of changes. The first relevant one is a change to the definition of an exempt organization. There was an extension, rather a change in the definition of an exempt organization for one with a religious charitable or education institution. Previously, the definition referred to one with public character. Now it refers to one whose object is not for profit. So, whereas previously the primary test was whether or not it had public character, now the primary test will be whether or not it is not for profit. The next was in the exemptions, we had some changes. Section 21(1)(z) of the Income Tax Act, which provided for an exemption for agro-processing, was repealed. This provision was an unlimited income tax exemption for those engaged in agro-processing. It was subject to renewal on an annual basis. So the reason for its repeal is because Section 21(1)(af) of the Income Tax Act also provides for an exemption for agro-processing. Section 21(1)(af) provides for general incentives for investors in particular sectors, and one of the sectors listed is agro-processing. So there was a bit of a duplication. So Section 21(1)(z), which provided for the annually renewed agro-processing exemption, has been repealed, and Section 21(1)(af) remains. So agro-processing, those who are in agro-processing could still pursue an exemption under Section 21(1)(af). However, the exemption under 21(1)(af) is subject to other conditions which were not applicable under Section 21(1)(z). These conditions include the threshold amount. For a foreigner, it is an investment of $10 million. For a citizen, it is an investment of $150,000 if it is upcountry, or $300,000 if it is not upcountry. Upcountry is defined as 50 kilometers from the boundaries of Kampala. Another amendment on the exemptions was the extension of Section 21(1)(af) to include other sectors. As I mentioned earlier, the Section 21(1)(af) caters for a number of sectors, and more were added this financial year, to be applicable this financial year, and these include the manufacturers of chemicals for agricultural use, industrial use, manufacturers of textiles, glassware, leather products, industrial machinery, electrical equipment, sanitary pads, and diapers. There is also an amendment to rental tax. This one is a bit of there were significant changes. Prior to this change, the position was, if it was a non-individual, a company, if it was a company that owned a building, the company was allowed unlimited deductions, and it was subject to the rate of 30%. Whereas for an individual, the individual had deductions which were capped at 20%. The individual was also allowed a threshold amount of 2,820,000 or 235,000 a month. That meant that if the rental income earned was below that threshold, it was not subject to tax. But there was also the deduction of 20%, which was an automatic deduction, which didn't have to be proved, but the individual could not claim any deduction beyond that. The individual was also allowed a deduction for mortgage interest for that property. So there have been significant change, and the individual was taxed at a rate of 20%, whereas the company was at 30%. So the change that has been introduced is that the deduction there's a deduction of 75%. That is for the individual. The 20% has been increased to 75%. The threshold amount of 2,820,000 annually or 235,000 monthly has been removed, and the rate has been increased from 20% to 30%. So for the individual, whereas the rate has been significantly increased by 10%, it should be noted that the allowable deduction has been increased by up to 75%. This is a very significant increment, and the net effect for most taxpayers is likely to be a lower effective tax rate. The effective tax rate is the actual amount that you pay as a percentage of the gross that you have earned. So for most taxpayers, they are going to find that the effective tax rate is going to be much lower. For companies, the same thing has been done. They have a 75% deduction, as well as all the other deductions that were allowed under the tax law. There's been a change in the depreciation classes. Previously, there have been 4 classes. They've now been reduced to 3 classes. The first one remains, that is computers and data handling at 40%. Then class 2 has been changed. Most of those that were in class 2 have been moved to class 3, and class 3 has been combined with class 4. So class 2, what has remained is plant and machinery used in farming, manufacturing, and mining, and this is at 30%. And then the rest that were in class 4 and class 3 remain in what is now class 3 and are at a rate of 20%. Then there are changes in the capital deductions. The previous position was that a taxpayer was in a position where they could claim both initial allowance for an item of eligible property, usually plant and machinery, or industrial building deduction for a building together with depreciation. So these deductions, they basically had 2 deductions that were applicable to them simultaneously. So what has been done is that these 2 have now been separated. When the taxpayer claims initial allowance, they will not be able to claim the depreciation until the period of initial allowance has run out. Then they will be able to claim depreciation. The same thing with industrial building deduction. There have been changes to the capital gains regime. What has been introduced is indexation. What is being indexed is the cost base. We should note that previously there was already a form of indexation, but it was tied up for assets that were in existence in 1998. I think March 1998. So what has been done is that indexation is now generally applicable. What indexation means is the cost base. That is, the way capital gains works is when you buy a business asset, let's say a commercial building, or construct a commercial building, and then use it, and maybe a decade later you choose to sell it, then the difference between the price at which you're selling it and the cost you incurred at the time of purchase will be a gain which is subject to tax. That is the capital gains tax. So what has been, the challenge was that for assets that came into existence after 1998, there was no accounting for inflation. Indexation accounts for inflation. So what has been done is that now the cost base will be allowed to change, that the cost base being the cost at which you either constructed or acquired that asset will be allowed to change to cater for inflation. This is done using the consumer price indices that are published by Uganda Bureau of Statistics. So the cost base will be multiplied by the consumer price index of the month in which you're selling the asset, and over the cost base, rather the consumer price index in the month in which you acquired that asset. The month prior to the month in which you acquired that asset. So you will have the cost base multiplied by, it's a formula that is available in the Act, in the statute. You have the cost base multiplied by that fraction, and it will, what will usually be the effect to cater for inflation is that the cost base will be increased to cater for inflation, and the gain will be reduced, thereby reducing the capital gains tax because of inflation being factored in. We also have the capital gains exemption for venture capital funds. Venture capital funds are registered with the Capital Markets Authority in Uganda. They are funds that they primarily target equity investments in high-risk businesses, high-risk sectors. So what this exemption does is that when a venture capital fund, a registered venture capital fund, invests in an entity, in a business, usually it will do that by acquiring shares, and then also running that entity for a period, then the shares are increase in value and are subsequently sold by the venture capital fund at a higher value. So if the venture capital fund reinvests 50% of the proceeds it gets from that sale of the shares, then there will be an exemption to the extent of what it reinvests. So if it reinvests 75% of the proceeds, then that 75 will not be subject to capital gains tax. The reinvestment must be done within 12 months or 1 year. We also have an amendment introducing the automatic exchange of information regulations under Section 88 of the Income Tax Act. The Tax Procedures Code Act already provides for exchange of information on request. So when a different revenue authority in another country wanted to get information, say on their residents who have invested in Uganda, they could request for that information from URA, and URA would seek it and submit it. But what we're introducing here is now automatic exchange of information, which is done even without a request. So what happens is that the different revenue authorities of different countries who are party to a treaty, there is a convention on this, are going to submit information relating to non-residents. That is, in Uganda, we will submit information relating to non-residents who have invested in Uganda. So we will submit that information to a general pool, and then from there we will extract information that is relating to residents in Uganda from the general pool, where all other revenue authorities have also submitted information.
Thank you,
We
Solomon.
also have the refund, Section 113 of the Income Tax Act, which provides that where the Commissioner requests for additional information, the application for refund shall be deemed to have been submitted on the date on which the additional information is received by the Commissioner. So basically what this means is that when a taxpayer has applied for a refund and the Commissioner General needs more information before the final determination on that application can be made, the date for calculating when the refund was, when the refund application was made will be considered the last day on which the last additional information has been submitted. Thank you.
Thank you very much, Solomon, for that. I received a question from Sheila. Sheila, good morning. Sheila is asking about rental tax for non-individuals. She's wondering whether you said that non-individuals are allowed a 75% deduction plus all other expenses incurred, and what's the tax percentage?
Thank you very much, Sheila. So for the non-individuals, they will, that is companies. For companies, they will be allowed the 75% deduction, and they will also be allowed all the other deductions available in the Act, in the statute. And the rate applicable to them is 30%. There has been no change in the rate for companies. The rate applicable for individuals is the one which has been increased from 20% to 30%. Thank you.
Okay, thank you, Solomon, for that. I think let us move on to the next tax type. The next amendments that we're going to look at, the excise duty amendments. This will be done by Fiona, who can give us an in-depth analysis of what excise duty amendments have occurred.
Thank you very much, Brian. Good morning, ladies and gentlemen, our dear clients. Welcome to this webinar. So I'm going to take you through the excise duty amendments as are contained under the Excise Duty Amendment Act 2021. So the first change we have under the amendment is in relation to Section 10, where the law is providing for refund or remittal of excise duty that is paid under the Act. However, this refund or remittal has to be qualified by certain requirements. So in a case where, for example, if the Commissioner General is satisfied that the plastic product is for use in packaging of products for export, or the packaging of medicaments, or it's is manufactured from recycled plastics, provided that the recycled plastics are up at least 20% of the raw materials used, then in such a case, you'll be entitled to a refund of excise duty incurred under the Excise Duty Act. Then we also have some changes under the second schedule. Now the second schedule does provide for the rates and rates applicable to the specific excisable products. And as you'll see, we do have a list of products. And for some of the products, we have we're having an increment in the excise duty, and in others we're having a reduction, and in some of them we're having new products being introduced under the schedule. So I'm going to take you through the schedule, the changes that have been made under the schedule, so you can see the difference. So the first one is the opaque beer, where initially we had excise duty at the rate of 30% or 650, and this rate has been increased effective 1st July 2021 it has been reduced, to 20% or 230 shillings per litre, whichever is higher. Then the next item is any other alcoholic beverage locally produced. This is a new product that has been introduced under the schedule, and these products will attract an excise duty of 20% or 230 shillings per litre, whichever is higher. The next item is any other non-alcoholic beverage locally produced other than the beverage referred to in the above provision. And this is also a new item that has been introduced under the schedule, and it attracts excise duty at the rate of 12% or 250 shillings per litre, whichever is higher. Now these two products which have been introduced that are new are products that have been covered under the dicto tax stamps regime, the dicto tracking solution. So they're meant to be covered under the dicto tax stamps. The next item is motor spirits, where the excise duty has been increased from 1,350 to 1,450 shillings per litre. The next item is gas oil, which was initially at 1,030 shillings per litre, and this has been increased to 1,130 shillings per litre. We do also have motor spirits, which has been increased from 1,350 shillings to 1,450 shillings. Then we do also have gas oil, which has been increased from 1,030 to 1,130 shillings. Then we do also have some other new products that have been introduced, and they include any other fermented beverages made from imported cider, perry, mead, spears, and near beer. And this attracts an excise duty rate of 60% or 950 shillings per litre, whichever is higher. We also have any other fermented beverages made from locally grown cider, perry mead, spears, or near beer, and this attracts a rate of 30% or 550 shillings per litre, whichever is higher. Furthermore, under the second schedule, we do have other items. For example, we have other excisable items. We do have an introduction of plastic products and plastic granules, which is at the rate of 2.5% or 70 USD per ton, whichever is higher. Please note that this is an expansion of the plastics regime, so we'll have more plastic products covered under this as opposed to our previous provision, which was restricted to the sacks and bags and polymers of ethylene and other plastic products. So this gives us a wider scope in terms of excise duty. Then we also do have an introduction of an exemption on construction materials of a manufacturer, other than a manufacturer referred to under item 21. And for one to qualify under this excise duty exemption, they must meet certain requirements. And the requirements are, one, that there must be a minimum investment capital of at least 50 million USD, or in the case of a manufacturer who makes an additional investment, it must be equivalent to 50 million United States dollars. Then the other item that is changing under the Excise Duty Act is telecommunication services. Now, under telecommunication services, there's effective 1st of July, you do not have to pay OTT, that is over-the-top services anymore for you to be able to access WhatsApp or Facebook or Twitter. So the 200 shillings that was levied initially on as OTT has been repealed. So that provision no longer applies, and that is why today you have telecom companies like MTN and Airtel sending you messages saying effective 1st July, you do not have to pay OTT to access WhatsApp and other social media platforms. And this is because that provision under the Excise Duty Amendment Act has been repealed. And so we do not have to pay OTT anymore. The other provision relating to excise duty is there's an introduction of excise duty at the rate of 12% on internet data. And this will apply across the board except for provision of medical services and education services. Now, in this respect, URA is working with the Ministry of Education and the Ministry of Health to provide us with a list of all the licensed providers under the education sector and medical services, and these persons will be exempted from the 12% excise duty on data. And please note that the excise duty is charged at the point of sale. So the telecom companies will exempt the education and medical service providers from the 12% excise duty at the point of sale. The other change we're having is under value-added services. Now, value-added services has been reduced. The rate has been reduced from 20% to 12% of the fee charged. Yes, so that is all of the changes under the excise duty regime. And just to remind you that these changes were effective on the 1st of July. So for most of you, you may have noticed a change in most of these excisable products, and it's because of the change in the law. So you have either experienced an increment or a reduction in the prices, and all this is due to the changes in the Excise Duty Amendment Act. Thank you.
All right. Thank you very much, Fiona, for that in-depth analysis. From the chat, I am seeing requests for this document. Please note that these amendments have been uploaded on our website, which is www.ura.go.ug. Look for laws. You'll find all tax amendments for 2021-2022. We have tried to summarize them as much as possible for simplicity and ease of discussion. If you want in-depth analysis for yourselves, feel free to visit our website to be able to do that. I think some of the notable changes under the excise duty regime, the repeal of the over-the-top services, OTT as it's famously known. Please note that you're no longer required to pay 200 shillings per day, as was the case in the past financial year. So this is to advise you all who have downloaded VPNs to avoid payment of this tax. You might not need to use that anymore. Simply load your data and access all the sites that you're willing to access. We had a few introductions that Fiona went through. You have products like ciders, which have been imported into the country. These are new products. We have ciders, theories, and mead. These are new products that have been introduced, and the excise duty rates have also been communicated to you. We have the issue of motor spirit and gas oil. For those of you who are not familiar with the terminology, motor spirit is actually petrol, what we usually look at as unleaded at Shell and other petrol stations. There's an increment of 100 shillings in excise duty. And also for gas oil, which is diesel, there's an increment of 100 shillings. The reason for this increment was to raise revenue, but also our parliamentarians thought it wise not to impose further duty or impose license fees on motor vehicle users. I received a question from Aban Mugabe. He's asking what happened to taxpayers who had paid OTT for the whole year up to 2021. Is URA going to be able to refund this money? What happens to taxpayers who paid that? Solomon, go ahead.
Yeah, thank you very much, Brian, and thank you very much, Mr. Aban Mugabe, for that question. So, for taxpayers who had paid beyond the period of 30th June 2021, we are working with the telecom companies to come up with a convenient mechanism for the refund to take place. And we actually issued a public notice. I believe this was on Friday last week. There was a public notice in both New Vision and that was 2nd July. There was a public notice issued in both New Vision and Daily Monitor that was to the effect that we are working with the telecom companies and we're going to come up with the most convenient mechanism for the refund to take place. Thank you very much.
Thank you, Solomon, for that. There's another question from Alfred Okema. He's asking, how is URA going to handle access to data by students doing online classes, e.g. university students across the country who may continue with their studies? I think, Alfred, that's a very good question, but you must note the complexity with which it would be for a telecom company to know that a student is using data for educational purposes. And that is why, as Fiona stated earlier, we are working out a mechanism where a list of all educational institutions and all medical facilities where the exemptions apply will be shared with the telecom companies. And what the telecom companies will do is that when an educational institution is buying data, then there will be an exemption for excise duty. But it will be very hard for a telecom company to know that Brian is studying from home, and therefore when Brian buys data, they will not charge excise duty. So that has, of course, some administrative challenges, but the only way that that can be mitigated is by URA working with the different regulatory bodies for the hospitals and schools to come up with a list. And once those institutions are purchasing data, then that exemption will be enjoyed. One more question from Mr. Kahindi. Peter, how are you? Good morning. Will internet service providers be in position to seek a refund where they incur the 12% duty from their supplier but are not in position to charge it? Where they, for instance, to supply to an educational service or medical institution. I think what Peter is asking is whether there will be a refund to the telecoms when they supply an exempt excisable product.
Thank you very much. Mr. Peter Kahindi, and for that question. The law is quite clear that these entities are exempt: education providers of education services and providers of medical services. As Fiona ably explained, the exemption will be at point of sale. So the telecom companies or the internet service providers are actually not going to charge in the first place. So there will be no charge made at that point when they sell internet data to these institutions. If inadvertently or under any circumstances otherwise a charge is made erroneously, then certainly a refund can be worked out. Thank you.
Solomon, I think just to add on to that, what Peter seems to be asking about is ISP providers, internet service providers, buy internet from internet providers, let's say from MTN or other providers of internet. When they're buying that internet in bundles, they will be charged excise duty.
Yes.
But now when this ISP is providing that same bundle to another client, who is a school, for example, which is exempt, they would have incurred excise duty at the point of purchase, but when they are selling, there's no excise duty. So will the ISP be able to claim that excise duty incurred?
Yes, thank you very much. We can work that out in greater detail, but yes, they should be able to claim it because the law specifically exempts the internet service providers from this excise duty. So they cannot be required in any way to pay it, whether directly or indirectly.
Thank you very much, Solomon. One more question before we go to the next presentation. James Mwere asks, what criteria did URA use to select education and medical for data tax exemption? Don't you think tourism should also be exempt on this list of exemptions? I think these are policy matters that sometimes we might not be very privy to. But I think given the current situation in the country where we have COVID-19, I think the sectors that were deemed to be greatly affected, not that tourism was not affected, I believe it was affected as well, but I think we can all agree that the educational institutions and medical services have been hit greater than other sectors. I believe this is something that may be considered for the next financial year. This is something that is being looked at for future use, but for now, the government will only provide incentive to the education and the medical sectors.
If I may, Brian? Maybe I can speak a bit about this, and Fiona will also come in a bit. It's on the issue of URA's mandate. Much as in the public's mind, every time they think of a tax law, they think of URA, we do not in fact make the law. So the way the question was framed suggests that it was URA that selected those sectors. The laws are made through Parliament, through a very clear process, and at the point in Parliament, there is even a period when the bills are made publicly available, and the public can come in and comment about the bills and recommend certain changes, and that is possible. So URA's primary role, whereas the URA Act does provide that we can give advice and guidance as regards the implementation of the law. Our primary role is just to implement the law. If you have something else.
Yes, thank you, Solomon and Brian. Yes, I just wanted to supplement on what Solomon and Brian just said. In regards to the law, our duty as URA is tax administration, but we do also advise the Ministry of Finance on issues of tax and tax policy. And yes, we did advise, but when it came to the exemptions, it was a decision that was taken at another level. And so, as he clearly put it out, when Ministry of Finance published the bills in the Gazette, the public was invited, as is always the case. The public is invited to have input in the bills before they actually passed into law. And what you see today, the resultant, the laws that we have today is due to public engagement and also Parliament's policy and URA and Ministry of Finance. And so in having medical services and education services, it's a result of that entire process. So it's not entirely upon URA, or it's not entirely URA's decision that medical services and education services be exempted from excise duty at the rate of 12%. I submit.
Thank you, Fiona. I think Fred.
I wanted to add on something to what Jimmy has asked. He raises a very good question, and it's a point that can be taken. However, one thing that we have to note here is that some of these exemptions are given after careful study of how is it done in other countries. You realize that tourism is also a growing sector in Uganda that needs to be supported. But when you looked at medical education, there was a critical need at that time that we need to first leave this out of the bracket. However, it's my view that we are going to take upon that, study it, look at the impact it has on our tourism sector, because we are involved in the tourism sector. And maybe with the support of the players in the tourism sector, who will have to come up and justify this, then it can be considered in the next financial amendments.
Thank you very much, Salongo. Now this is the real last question before we move on to the VAT amendments. There's a question from Kev. Is excise duty on internet charged together with VAT, or is internet exempt from VAT because it is taxed by excise duty? I'd like to advise that one, VAT excise data is not exempt from VAT. So the answer to your question is yes, excise duty forms part of the tax base for VAT, and that means excise duty and VAT are charged on data when data is being supplied to you by the telecom companies or ISPs. What you need to note is that when they are computing VAT, the VAT figure shall be inclusive of excise duty, because the consideration for VAT purposes also looks at duties which are added on. I hope that creates clarity. Rita Nalubanga says, in regards to the income tax amendment and the changes to the 6th schedule, how will the change be effected for taxpayers who do not have records of the composition of the assets included in the current written down values when they migrate to the 3 classes? I don't know if Solomon, you've understood the question and you're willing to answer that.
I can attempt it. Maybe you could repeat it.
This is from Rita Nalwanga. She asks, this is in regards to the Income Tax Act amendment. In regards to the changes to the 6th schedule, how will the change be effected for taxpayers who do not have records of the composition of the assets included in the current written down values when they migrate to the 3 classes?
Why do they not have records? The law requires taxpayers to have records.
No, I think, Rita, this question is a bit ambiguous, so we might not be able to give guidance on that.
But maybe just to clarify regarding record keeping, because the law does require taxpayers to keep their tax records for 5 years. that under the Tax Procedures Code Act. So it's a legal obligation for them to have records. If they do not have records, that's actually a bit of a, there's a penalty for that. But even before we go there, that's also going to be a challenge to them in this sense that we are in a self-assessment regime under Section 20 of the Tax Procedures Code Act. And in a self-assessment regime, you, the taxpayer, are the one with the records. And we assess you based on what you communicate to us in the tax return. So if you do not have clear and proper records, which you can base on to assess yourself, then you're going to have a bit of a challenge being a compliant taxpayer. Thank you.
Thank you very much. Thank you for the questions that are coming in. It's very good to know that our listeners are actually paying attention and are very interested in the policy changes that have come into our laws. There are some questions which I might not answer because they might not necessarily be related to the topics at hand, so forgive me for that. Someone asks if guest houses or lodges charge VAT on their price. The answer is they should. Why is it that Facebook cannot be accessed without VPN? That is because our government banned Facebook due to political reasons, which I'm not comfortable getting into. So what we're going to do now is we're going to move on to the VAT amendments. Salongo will take us through this, and after that we'll take a next set of questions and keep listening. Thank you very much.
Thank you very much. Good morning, our viewers. And before we go into the VAT amendments, maybe I could clarify on the last person who asked about guest houses are charging VAT. If those guest houses are in Kampala, the exemption stopped in June. But if they are up country, as defined in the VAT Act, they are still exempt from VAT because they fall under tourist hotels and whatever. So that's the criteria. Maybe also somebody was trying to clarify, to ask a clarification on whether our local brew, Marwa and Tonto, is covered when they talk about fermented locally manufactured beverages. And I think they are covered because if they are produced under a fermentation process, so our Marwa, our Tonto, will have to pay excise duty at a rate of 30% or 550 shillings per litre, whichever is high. So that's putting aside that clarity. I start with the VAT amendment provisions, and Section 28 was amended to require that input tax credit can only be claimed within 6 months from the date of the invoice. This means that previously what has been happening, you could purchase something, you don't claim the input tax therein, some time passes or even a year, then you claim that input tax. Now it has been clarified, your input tax credit can only be available for not more than 6 months. Beyond that, that invoice will not be allowed. Again, Section 31A was inserted to require non-resident providers of electronic services to final consumers to file returns. When we talk about non-resident providers, we talk about companies like Google, Facebook, those Netflix, who provide electronic services to consumers in Uganda. And final consumers are basically those who are not registered for tax or not registered for VAT. So a mechanism is going to be put in our system to enable these non-resident providers of services to file returns in Uganda. This is a plus for the country because now we are expanding the tax base to even tax those who earn income in Uganda but are not resident here. When you are part of a team that will be handling this, you will find in our portal returns shall be put there for such services. However, this may not apply for those who are already registered for VAT because the reverse mechanism is always working for them. Again, the VAT Act, we have included, currently, URA is pursuing the electronic physical receipting and invoicing solution, and to encourage people to issue receipts electronically. A person who purchases from any other party who is supposed to give him an invoice is going to be given a refund of 5% of the amount of VAT he has incurred. Let me clarify this in a lay understanding that you want to buy something from maybe game, you're going to buy your TVs, merchandise, everything you buy, and you incur VAT. Now, as a patriotic Ugandan, would expect you to ask the supplier or the person selling you that you give me a receipt, and this receipt must come from the EFRIS system. Now, as an incentive, when you get that receipt, you are going to get 5% of the amount of the VAT you've incurred as a refund to you. If you bought 10 TVs from game, each TV at 2 billion, that means you've incurred 10 million, and that means you've exceeded the threshold of 5 million in a month. The VAT amount you would have incurred on such purchases, 5% of it shall be refunded to you. How are you going to implement this? Because I know people are going to ask, how is it going to be possible? Make sure when you are buying these items, you provide your tax identification number to the person supplying you. If you don't have a tax identification number, you can provide your national ID number or even your telephone, such that when you provide a TIN to those people, automatically this money will be credited to your TIN account and it will be refunded through mobile money. Questions can be asked about that, but that's the law now. Whoever incurs VAT and you've made purchases in excess of, purchases worth 5 million and above for a consecutive period of 30 days, you can claim 5% of that money incurred as VAT. Previously, also, there's been a penalty under Section 65(6), which would penalize a taxpayer who knowingly and recklessly misleads a URA official by maybe furnishing a return which is incorrect. Now, some words have been removed from this penalty, especially words knowingly or recklessly, and this is the benefit of the taxpayer. The penalty is still standing, but how it comes about, you no longer need to have knowingly or recklessly submitted a return or done an omission for you to suffer from this penalty. So this is a clarity, or this is a win for our taxpayers, and as far as when you are implementing the penalty regimes. There are exemptions that were given to hotel investors, and we realized in the previous law, the VAT Act, there were contradictions. There were 3 provisions which were talking about the same exemption. Now, in this VAT Amendment Act, paragraph 1BV, in relation to exemption for hotel construction, has been removed. And what has been left is paragraph 122 and paragraph 1LLL. Those ones are still there. When you go through when you read in detail these provisions, they are giving exemptions for VAT on purchases a person would make if he is putting up a hotel facility in Uganda, and the conditions therein are very favorable for the taxpayers. Then paragraph 1XX, which exempted the supply of production inputs into limestone mining and processing into clinker in Uganda, and the supply of clinker for further value addition, has also been removed, meaning that the supply of such items is no longer exempt. Again, for emphasis, they have introduced a paragraph 1HB exempting the supply of liquefied gas and the natural fuel ethanol from cassava. Those who can look at the law, you'll see that previously there was a specific liquefied gas, that was petroleum liquefied gas. Now, all liquefied gas is exempt. More to the investment exemptions, there is an exemption for the supply under 1AA exempts the supply of services to a manufacturer whose investment capital is at least 30 million USD for foreign investor or 5 million USD for a local investor to conduct feasibility study or undertake design and construction, or in case of any other manufacturer from the date on which the manufacturer makes additional investment equivalent to that amount of 30 million USD for foreigner and 5 million USD for a local investor. Let me clarify on this exemption. These exemptions have been there in the law, only that they are being clarified further. In the previous law, the exemption has been with some conditions. And one of the conditions was that somebody should have been dealing in a particular sector. And some of the sectors referred to here were agricultural processing, vocational schools, manufacture of mattresses and whatever. Now, this exemption you're seeing under 1MM does not require any sector. Doesn't matter what you are dealing in. So long as you have come up with your money and you're going to invest 30 million USD for a foreigner, or in the case of a Uganda or a local investor, it is 5 million USD. So the preference is being given to a local investor over a foreign investor. What does it, how does it apply that? It means that the items you are going to purchase when you are putting up this investment, they will not attract VAT. You will be exempted from VAT on such services and goods you purchase for construction and whatever. Again, in the third schedule, they have introduced a paragraph 1K which zero-rates the supply of leased aircraft engines, spare parts for aircraft maintenance, equipment and repair services. What does zero rating mean? It means that when you lease an aircraft, or when you purchase aircraft engines, spare parts, or you do aircraft maintenance, you are not going to pay VAT. The VAT will be charged at 0%.
Okay, thank you very much, Fred, for that. For those investors that are out there, there are incentives that you can take advantage of, but there are capital and there are certain thresholds that need to be considered. In the chat group, we have had a question from Alfred Okema. Thank you for your question, Alfred. He asks, please explain to the ordinary Uganda how VAT works and how, when the excise duty is charged, double taxation is dealt with. I think Alfred is asking about the issue of data, where you have excise duty and VAT being imposed on the same supplier. How do we ensure that there's no double taxation? And if at all, is there double taxation? Solomon, kindly shed some more light on that for the benefit of listeners and viewers.
Without being so much technical, each of these tax heads are taxed under different laws. And you're going to realize that not every item you purchase attracts excise duty. Excise duty is only on such items that are deemed fit. When we were doing economics at the university, they used to tell you goods of what? Goods of ostentation. Now, these are items which Parliament looks at and says, okay, these are items that are not so critical for someone's survival, that without them we cannot survive. Government collects taxes on them. Now, the way these taxes are administered is that when somebody purchases an item, excise duty is first added to the cost of the item. Then later on, VAT is added to the cost of the item. But we need to note one thing, that VAT is paid by the final consumer. It's not, it says a mild stage tax. It's collected by everybody, but you get a refund of it or a credit for it as you add value to an item. Now, excise duty will be paid, fine, at the point of purchase. It will be part of the cost of the article we bought for those selected items and services. But VAT, you will collect, you will incur, then you will collect on behalf of government. But before you pass over to government, you have to deduct what you paid at purchase. It's the person at the final end who incur the burden of VAT. That's how it's provided for in the law. Now, I wouldn't say it's double taxation the way people want to take it, but these are taxes provided for in that case. There are items on which excise duty does not apply, and those items will only suffer VAT, and that VAT will only be paid by the person consuming the item. You realize well that there are some exemptions for even excise duty, that if somebody is getting an item on which he has paid excise duty and using the same item to manufacture another item, or another item of a medical nature, which is so crucial for someone's survival, that the excise duty is refunded to him. Meaning that the person consuming the product at the final end will not suffer the excise duty. So excise duty is governed differently from VAT, and it's imposed for different reasons. When we go into that discussion, we cannot end today.
Okay, thank you very much, Solomon, for that clarification. I hope that gives you shed some light to you, Alfred. We have a few more questions in the chat group. Nakaziwe Lydia, you asked, does the 5% refund of VAT apply to companies? The straight answer is no. The refund is only to those persons who are not registered for VAT. So if a company is not registered for VAT because of the nature of supplies that it makes, I do not think it would be excluded. So basically the only exclusion for this provision is those persons who are registered from VAT.
Maybe to clarify on that, why companies are not covered here? Companies have an advantage of claiming it. So it's not that they're going to suffer it. So they already have a benefit of claiming input tax.
Okay, Brian, just to add.
Sorry, go ahead.
Yeah, just to add on to what Brian and Salom have said, the rationale behind this policy proposal is we're trying to promote EFRIS as a campaign. So we're encouraging taxpayers to claim for receipts, but also to encourage the VAT registered persons to use the EFRIS system, which is the electronic fiscal receipting and invoicing system. So when you go out to purchase items from these VAT registered persons, we expect you to ask for a receipt, and that receipt has to be a fiscalized receipt. And in that way, you'll be able to claim the VAT refund on the items you have purchased.
Thank you, Fiona, for that. Regarding EFRIS, we have another question from Ida. Ida asks, the EFRIS system is automated in such a way that you can only claim input VAT on e-invoices submitted in that period. How can one go about claiming input for an invoice out of the invoice period, but still within the 6 months allowed? Do you?
I think I've understood the question. The taxpayer, that is Ms. Nakaziwe, right?
That's Ida, Iran.
Oh, okay. Sorry about that. Yeah, the taxpayer seems to be saying that EFRIS is configured in such a way that they can only claim input for that specific period, right? And yet the law is giving them 6 months. So because whatever system we create is always subject to the law, the system is going to be configured in such a way that it will allow this to happen. Thank you.
I think we already answered the question about the 5% refund. Rita asks, does the 5% refund apply to international organizations or diplomats entitled to refunds? I think under the VAT law, international organizations and diplomats are already entitled to refunds. So they will not benefit from the 5% refund on VAT incurred. What would happen is that they would be able to claim all the input tax or all the VAT that they have incurred when they make any purchases in accordance with the VAT law. This other provision, as my colleague Fiona mentioned, it is to encourage us to ask and get accountability for EFRIS receipts. So when you make purchases, ensure that you ask for your receipt and make sure it's an e-invoice, and also give them your team details for purposes of being able to get a refund of 5% on the VAT that you have incurred in a period of 30 days where your purchases exceed 5 million shillings. Maybo asks, hello, due to lockdown, we were unable to file returns, so would like to have technical support on how to fill them, and what is the grace period until the deadline, since we cannot cross to another district. Maybe we have helplines that we should be able to share the numbers on. Our toll-free line is 0800. Just hold on, let me get that for you. You should be able to call our help-free lines, toll-free lines, and be given any assistance regarding your failure to file your return. In the alternative, you can get in touch with your tax district where you file your returns and seek for an extension of time within which to file and pay your taxes. That is if it is not too late already. Peter, I am running a school and it's now 2 years. Our businesses are down and managing to pay, but for the income tax, I don't know how to go about them, but I'm sorry I joined the meeting late. That is from Peter. Just hold on for a minute. I want to give you the toll-free line. The toll-free line is 0800 117 000 or 0800 217 000. I repeat that. 0800, that is 0800 117 000 or 0800 217 000. You can reach us on those lines. Call if you need any assistance from URA. We should be able to give you guidance. Regarding lockdown and schools, I'm a school and it's been 2 years. Our businesses are down and managing to pay payee. Peter, thank you for still paying the teachers and paying payee to URA. But for income tax, you don't know. I think what will happen, Peter, is that you will file your returns in the normal way. If you are indeed making a loss, there will be no income tax payable due to the current circumstances. We are all very cognitive and aware that schools have not been operational, and most of them are definitely operating at a loss. Some of them are operating online, but even then, they probably are still meeting higher costs than they are making income. So we do expect that we will be able to file, but we might be allowed to file losses, and that is acceptable, and no tax will be payable there too. Maybe you say due to lockdown you are unable to file returns, so would like to have technical support on how to fill them. Maybe refer to the call centers. There will be someone who will give you a point-by-point guidance.
Regarding the filing of the returns, I believe that there's been a webinar on return filing. That was every
The last 2 weeks.
Yeah, for the last 2 weeks, there's been an ongoing webinar guiding taxpayers on return filing. There are also guides available, graphic guides are available on the URA web portal on how to file a return, and there are also YouTube videos which offer guidance on how to file tax returns. But also, as Brian has guided, in case you need further assistance, feel free to contact us on the toll-free numbers that he read out. Thank you.
Thank you. Thank you, Solomon. Nicholas, you asked about whether the customs measures will be shared with you as well. There will be another webinar specifically to handle customs issues. The reason that that is not going to be done today is because the content from domestic taxes amendments and the customs amendments is quite big. Doing that in one webinar will probably take too long and might bore some of you. Therefore, there will be another webinar for the customs measures. Someone is asking, are schools supposed to file VAT because they received a message on VAT? Schools ordinarily, if you're only offering educational services and there are no other incidental services that you offer, you would not be required to register for VAT, as the services that you're offering are exempt from VAT. I think where a school might be required to file and register for VAT is if they offer any other services. For example, if you offer whole hiring services and you charge for that and you meet the threshold requirements, you would be required to file VAT. I think those are all the questions we're going to answer regarding VAT for now. I will come back later for any other questions. Let us move on to further tax policy changes. We have the Tax Procedures Code Act. Those changes will be discussed by Fiona, TPC. So Fiona, kindly take us through the TPCA amendment changes.
Thank you, Brian. I am going to take you through the TPC Tax Procedures Code Amendment Act 2021 to bring to light what has changed under the law, what has been introduced, what is being excluded going forward. So the first item I'm going to look at is in relation to Section 5 of the TPC Amendment Act, and it creates an obligation on every authority, every government authority, agency, any person that issues a license, any kind of license to a person to perform any kind of business. And so the requirement is that before such license is issued, the client, the taxpayer, must provide a TIN. So this is to let you know, our dear clients and taxpayers, that if you're looking to open up a business going forward, effective 1st July, then you'll be required to produce your TIN before a license is granted to you. So please take note of that. When you go to these agencies and you're denied a license, it's because you do not have a TIN. And like we have indicated earlier, as Brian has indicated, we do have, he's provided our toll-free lines. Please feel free to call us if you're having a challenge in getting a TIN by yourself. The process is very clear. You can get it online yourself. But if you have challenges, please feel free to call the toll-free lines, or you can walk into one of our offices. We do appreciate that there's a lockdown that's running right now, but we, as you are aware, are considered essential workers, so our offices are open and they will be more than ready to help you to get a TIN for yourself so that you can be able to register your business and get a license. The other requirement relates, the other tax policy change relates to tax agents. And there's an introduction that bars any person that is not registered as a tax agent from performing the duties of a tax agent. And the law also goes ahead, under this amendment, goes ahead to provide for a penalty for persons that are withholding as tax agents, and yet they're not actually registered as tax agents. The law is very clear. Every person that is acting as a tax agent must be registered, and we do have a register of tax agents, and we do communicate with them on a regular basis. So there is a standard and the requirements that these tax agents are expected to maintain. So for you to be able to act as a tax agent, you must be registered. If you fall short of that registration and you're found acting in that capacity, then you'll be penalized with a fine of up to 480,000 Uganda shillings or 1 year of imprisonment. However, I would also like to clarify that this policy change does not affect advocates, because as advocates, you'll be representing your clients in a court of law, and you're acting in your professional capacity, and therefore that is a different representation as opposed to handling the taxpayers' tax affairs. And also, just to let you know, this is it comes as a reward to the registered taxpayers, to the registered tax agents. We do appreciate the role that you play as tax agents, and we appreciate the connection that you play in terms of bridging the gap between URA and the taxpayers. And so in bridging this and in creating and protecting this, your profession, we're trying to reward you for the work that you do, and that's why we're saying if you're not a registered tax agent, then you should not be dealing in the affairs of relating to tax matters for clients. The other introduction relates to the digital tracking solution. As you are aware, URA has been implementing the digital tracking solution since 2019, and we do have a list of products and a list of, and we do have offences and penalties that we created under the law, under Section 19. And from the experience we have had in implementing digital tracking solution, we realize that there are certain areas that are still grey, and we're trying to close the loopholes, to close in as much as possible. So in this amendment, we are creating, we do realize that there are certain offences that have to be specific. So this amendment creates other offences. We do have offences and penalties that have been created in respect of these offences. For example, under Section 19 B5, there's a penalty for attempting to acquire or sell stamps without goods. Under this digital tracking solution regime, we do have manufacturers and producers, and these persons we do communicate with them regularly, and so we know the products that they actually produce and the products for which they are supposed to affix tax stamps. Now, in a case where you affix, where you found acquiring, or where you acquire sell a stamp without a good on it. So if you're a producer and you purchase stamps and then you sell these stamps without affixing them on a good, then you'll have committed an offense, and the penalty will follow under the law, which is a fine not exceeding 10 million or imprisonment not exceeding 5 years or both. Another penalty offense we have created is in relation to Section 19B6, which is creates an offense of affixing stamps on goods other than the goods approved by the Commissioner. As the law is, and as we have communicated, we do have a list of products on which tax stamps must be affixed, and we have gazetted these items in the Gazette. The Commissioner General has gazetted the items, and we have gazetted also the prices that relate to these products. So in a case where you are found affixing goods, you're fixing stamps on goods other than those that have been approved by the Commissioner and gazetted, then you'll have committed an offense, and such offense attracts a penalty which is double the tax on the goods, or 10 million Uganda shillings, whichever is higher. The other amendment relates to amendment of returns. We appreciate the challenges sometimes that are faced by taxpayers, and as a result, it has been considered, and the period for amendment of returns has been increased. The period within which a taxpayer can amend a return has been increased from 12 months to 3 years. So this is meant to give you the flexibility in case you want to amend your returns. Please be advised that the period has been increased from 12 months to 3 years. That gives you the flexibility, and we know that it will result into better tax management. We have also introduced alternative dispute resolution, which is ADR. Now, alternative dispute resolution caters for other mechanisms that we can use to solve disputes, tax disputes that may arise between URA and our esteemed taxpayers. And so what we are saying in this, what this amendment is communicating is that as a taxpayer, we don't always have to run to court, but you can come to us and we resolve the tax dispute in a manner that will save time. As the practice is today, we do have, the law provides for a period within which a taxpayer who is dissatisfied with a tax decision may object to a decision, and also provides for a process after objection. So where you are dissatisfied with the decision that has been made by the Commissioner General, then you can object to the decision, and if you're still dissatisfied with the objection decision, then you may go to TAT. But what we are saying is after the objections and appeals division of URA has made a decision and you're not satisfied, rather than you running to court, let us sit down, let us look at your tax dispute, let us find a way to resolve this dispute without having to go to court. And this is against the backdrop that litigation in itself, one, is very expensive, and then two, it is time consuming. So we're trying to find a way to solve these disputes in a way that is convenient, that is cheaper for you as a taxpayer and also for us as URA. And in return, we also know that most times you'd have matters that are in court and yet revenue is tied to them. So we're trying to find a way that we can help each other, help you as a taxpayer and help URA, find a way to resolve these disputes and move forward so that we have the best working relationship and we have our taxpayers happy, we have URA happy, revenue is coming in, and everyone is happy. So now in relation to this alternative dispute resolution, we have the law in place and we are also developing regulations, and the regulations will guide us on the kind of matters that we will settle under alternative dispute resolution. It will also guide us on the persons that can handle settle these cases, and also the time period. It will provide for all the detail that is required in respect of alternative dispute resolution. And I do know that many of you may have so many questions at this point, but for your comfort, please be advised that we are developing advanced stages of preparing the regulations, and these regulations will be approved by the respective authorities, which is the Ministry of Finance and the Ministry of Justice, and we will have the regulations gazetted so that the public can know exactly how this alternative dispute resolution is going to be managed by URA and what you need to know as a taxpayer in case you want to have your matter go through the alternative dispute resolution process. The other policy amendment is in relation to section 38.2, which provision has been repealed. That provision initially provided for the allocation rule in terms of the tax liability, but going forward, this provision has been repealed, and it's an advantage to you as a taxpayer because as opposed to earlier where URA would determine the allocation of your tax liability, what we are saying now is you can decide how your payments in respect of taxes will be allocated, and so the procedure is very clear to everyone, both the taxpayer and to URA. Then we also do have policy changes in respect of sections 54 to 63, and they relate to enhancement of penalties. Penalties committed in relation to the TPC. The law as it was provided for penalties. However, from our various interactions and the matters we have handled, we did realize that some of these penalties are not stringent enough because we have taxpayers committing these offences again and again. So what URA has come out to do and what government has come out to do is to enhance these penalties so that in committing these offences, the taxpayer will feel the penalty imposed in respect of a particular offense, and it will act as a deterrent. Yes. Yes, so what I was saying is that under these amendments, what we're trying to consider is, and we're trying to make the penalties provided for under the law, to make them more stringent, so that in committing these offences, the taxpayers will appreciate the pain, and these, so that these provisions will act as a deterrent factor. You know, we're going forward that you be penalized and penalized higher. I'll give you an example. For example, under section 55 of the Amendment Act, the penalty, we have increased the penalty from 25 currency points to 100 currency points. Now that increment from 25 currency points to 100 currency points is a huge increment. So a taxpayer looking at this enhanced penalty would think twice, even as you commit these offences. And I know sometimes it's not because the taxpayers want to do this, but maybe you're pushed to commit these offences, but have it at the back of your minds that the penalties have been enhanced and they're meant to act as deterrents to committing these crimes. I would like to go into the detail of all the offences. However, due to time, we do have the detail of these offences in our presentation, so I'll not go into the detail of it, but the presentation will clearly explain to you the enhancement, the manner in which the particular penalty has been enhanced, and so you'll see that it's meant to act as a deterrent in that respect. Yes, that is it for the Tax Procedures Code Act. Thank you.
Thank you very much, Fiona, for that in-depth analysis of the Tax Procedure Code amendment. As usual, we shall go back to the questions that are coming into the chat group. I will start with the questions that relate to the most recent presentation. I have a question from John Mary Ategeka. Is the window for registering tax agents open? I think I will ask Fred to answer that. And also, if you may, please comment on the penalties for the tax agent and the gravity of the offense of a tax agent acting on behalf of the taxpayer when they are not registered.
Thank you. I wanted to emphasize, let's first understand, when we talk about the tax agent has a bigger definition in the Tax Procedure Code Act. But in our understanding, somebody who works for you, somebody who assists you to prepare returns, somebody who assists you to present yourself at URA can be considered a tax agent. Now, previously, there's been a cry that everyone can act as a tax agent, and this has affected so many people, especially professionals. Because the Tax Procedure Code Act requires that for a person to be a tax agent, first of all, he must be of a certain qualification and experience, which must have attained over a period of 2 years and above. Then he must be registered with the URA, so that he is accredited and certified to act as a tax agent. So what has been happening, that those who applied and got accreditation from URA were competing with those who are not accredited. Now, due to that, URA proposed an amendment to the law that let there be sanctions to sanction those who purpose to be tax agents if they are not tax agents. And that's why you are seeing this penalty coming in, that any person who is not registered as a tax agent cannot act on behalf of a taxpayer to address tax issues. A tax agent list is always found on our web portal. So I would urge taxpayers that before you appoint somebody as a tax agent, go to our portal and first ascertain, is this person accredited by URA? If he's accredited by URA, you find his name and his company, and then you can transact with him. This is also to protect taxpayers who have come complaining to URA that those records you are seeing, those returns you are seeing are not mine. I don't know who did them. I don't know who, I mean, my agent did them without my authorization. And would have been, it has become very difficult for URA to follow up somebody whom they don't know. So that's why you are seeing that registration of tax agents is required. Then they are accredited, they are given certificates to operate for a period. In case something happens, we can collectively follow up this person for professional negligence. So I urge you, those who are not registered, the window is now open. You can apply. It's continuously open. Continue applying. And the window is running for 12 months. So by the end of December, those who are registered for 2021 will have to reapply. So if you have not yet applied, please apply and operate as an accredited tax agent. We've instituted internal measures where somebody who is not accredited cannot act on behalf of a taxpayer unless when you are a lawyer acting in the capacity of an attorney. Short of that, you cannot act.
What are the qualifications?
Some of the qualifications that are written in Tax Procedures Act is that you must have a degree in tax-related courses, like you have BCom, you have BBA. Then there are those who have done advanced taxation, advanced diploma in taxation. Or if somebody has acted, has engaged himself in tax work for the previous 5 years, they are also considered. So it's a wide thing under the Tax Procedures Code Act. But the most important thing here to note is that you must apply, get registered with URA, be put on the web portal for taxpayers to know that you're a registered tax agent, and then you act. Now, if you don't act, effective from 1st July, you are going to get, if you don't get registration, from 1st July, you are going to be getting a penalty of 480,000 or 1 year imprisonment if you purport to act as a tax agent without certification.
Okay, thank you very much, Salongo. There are more questions that we will need to discuss. Some of them still relate to VAT. Samuel Onono, you ask, why is it that when filing VAT returns with an exempt component, the input tax is not credited to reduce the VAT due? Mr. Onono, please note that if you're dealing in exempt supplies, the law does not allow or permit a claim of input tax related to those exempt supplies. However, if you make exempt and other taxable supplies, you may apportion a new input tax so that you may be able to get a higher credit for your supplies. Winnie asks, do you charge VAT on the construction contract? I believe if the construction contract is not to an investor who has an exemption given by URA, they should be able to pay VAT on those services that are provided. Mr. Salom, I'm afraid, if one is not registered for VAT, is it legal for that company to register on EFRIS? Because the EFRIS system helps one keep records. That's a direct question to Salongo, if you would like to answer that. The question to you is if you're not registered for EFRIS,
yes.
Can you still register for, if you're not registered for VAT,
yes.
Can you still register for EFRIS?
First of all, registering for EFRIS, if you are VAT registered, is mandatory. And registering for EFRIS, if you are not VAT registered, is optional as of now. So you can register.
Thank you very much. This one will go to Fiona. Regarding the alternative dispute resolution, are you still required to pay 30% of the claimed amount as a deposit before the ADR commences?
Thank you, Brian. Thank you. What's the name of this? Thank you, our dear taxpayer. Now, as I indicated earlier, the procedure, what we have in the law today is such that where a taxpayer is aggrieved by a tax decision made by URA, then they can object. And if after going through the objection and appeals process, the taxpayer is still dissatisfied, then that is when that's when the policy change comes in to allow them to pursue alternative dispute resolution. Now, the 30% that you're asking about relates to bringing your dispute before TAT, and the law requires under the TAT Act that the 30% must be paid before a matter can be heard in the Tax Appeals Tribunal. But because this ADR that we are presenting to taxpayers is before a taxpayer gets to TAT, so it's the process before you get to the Tax Appeals Tribunal, the 30% will not apply. Please note the 30% applies when the dispute has been filed before the Tax Appeals Tribunal.
Okay, Fiona, in relation to that very issue as well, we have a question from Rita Nalubanga. Thank you, Rita, for your question. She asks, does the alternative dispute mechanism have timelines as to when the dispute will be concluded? This is aimed at managing the 30-day TAT application timeline, as the taxpayer loses the TAT avenue if the dispute is not resolved before the 30 days expire.
Thank you, Rita, for your question. Now, in coming up with this policy proposal, we were alive to the facts of, we are alive to the timelines provided for under the law. And like I indicated earlier, we are in the advanced stages of preparing the regulations relating to alternative dispute resolution, and all that detail will be considered in the regulations. And we will also take cognizance of the timelines within which you must file a suit before the Tax Appeals Tribunal. So yes, we will have that into consideration, and all the detail that you require relating to alternative dispute resolution will be contained in the regulations, which once approved will be gazetted and shared on the URA website for all the taxpayers to access.
Okay. Thank you very much, Fiona. Solomon, this one is for you from Patience Akurut. She requests for more clarity on the repeal of Section 38(2) of the TPCA on the allocation rule. Please enlighten us a bit about that.
Okay, thank you very much, Ms. Patience Akurut. So Section 38(2) provides for the earliest liability. In the Section 38(2) of the Tax Procedures Code Act provides for the earliest liability rule. So what it says is that when a payment is made by the taxpayer, it is allocated to its earliest liability in the order of Section 38(1). And Section 38(1) provides for the order of principal, penalty, and interest. What this meant was that when a taxpayer made a payment, let's say a taxpayer has a liability for 2016, which they may not be aware of perhaps, or they had ignored, or for whatever reason they may not have attended to that particular liability. Subsequently, the taxpayer files a return for 2019 and attempts to make a payment for 2019 for that specific liability that they are aware of 2019 in their return, which is a principal liability, the principal tax for 2019. The Section 38(2) required that that payment which is made for 2019 be allocated to 2016, to the earliest liability. And it would be allocated in the order of principal, penalty, and interest. So the principal liability of 2016 would be cleared first, then any penalties from 2016 and the interest from 2016. Then what is left would then be used to clear the next liability in the order of earliest liability. So by removing this requirement, and maybe what we can note is that the result of this was that very often what the taxpayer thought they had paid for was not what URA had cleared. So the taxpayer would come and say perhaps they have cleared 2019. They would consider, such a taxpayer in the example I have given, would consider that 2019 has been cleared. But say come 2021, the taxpayer would find that the 2019 principal liability is still outstanding, simply because the amount that was paid was taken to clear the earlier liability. So this earliest liability rule has been removed. The primary benefit that would arise from this is that what the taxpayer pays for is what is actually cleared. So whatever the taxpayer chooses to clear, if they choose to clear their earliest liability, which is what we would always advise, it is what would be cleared first, because an earlier liability will continue to accrue interest until it is capped. That is when the interest equals the liability. So it is always better to clear the earliest liability first. However, the law will no longer make this automatic and mandatory. The taxpayer will have the right to choose which liability they choose to clear first, and they can clear the current liability and move on if perhaps they consider that the earlier liability might be contestable. Thank you very much. I hope that clarifies the issue for patients.
All right. Thank you, Solomon. The next one goes to Salongo. How will a non-resident service provider file a quarterly return when they are not registered for VAT? Because a person is required to have a TIN and physical location in order to be registered for VAT. This is from Harriet.
When we are proposing that amendment, first of all, to increase the tax base, we had to get away of capturing the non-residents who are providing services here. You realize that there's a lot of money or income being earned in Uganda which is not taxed by non-residents. So we had to come up with a suggestion. And first of all, we got the provision in the law. Now we are supposed to put into place a mechanism of how these people are to be registered. Now, these people are going to be given a special regime of registration, a simple one, which does not complicate matters. Because what we're interested in is to have a fair share of their tax paid in Uganda. Like it's done in other countries, these are big companies, they have presence all over the world, but it's about getting it simple for them to register. At the moment, we've not put in place the regulations that will be followed to have these people registered in Uganda. When that is put in place, we shall have them registered. However, what we had put in the law earlier on, which is still being not taken up, is the idea of a tax representative. Now, such non-residents can take advantage of the provision of the tax representative, meaning that where a person is not present in Uganda, but is earning income in Uganda, that is subject to tax, he can appoint a tax representative who will take responsibility of his return filing, registration, and tax payment. That one is already there in the Tax Procedure Code Act. But we are moving a step further to make it simple for those that are not yet ready to take the avenue of the tax representative.
Thank you very much, Solomon, for that.
Maybe can I clarify something?
Please go ahead.
Yeah, it is not true that the law requires you to have a physical presence in Uganda for you to be registered for VAT. If you read those provisions correctly, I would advise that you just go back and read them somewhat slowly. You will find that it is only mandatory for you to have that place of abode if you are registering voluntarily. That is, you may not meet the threshold, but you've chosen to register voluntarily. But if you do meet the threshold, your excuse for non-registration can't simply be that you do not have a permanent place of abode as the law requires. That requirement isn't there. Once you meet the threshold, it is mandatory, and you're dealing in taxable supplies, then it is mandatory for you to register, regardless of whether or not you have that physical place of abode.
Thank you very much. We are slowly running out of time. Let us go to the next policy changes, and then we shall come back and answer a few more questions. Solomon will take us through the stamp duty amendment. They are quite brief, so that shouldn't take us too long.
Thank you very much, Brian. So for stamp duty, we have there are very few amendments. The first relates to the investor incentives. We've talked about investor incentives. I talked about them in the Income Tax Act, the ones under Section 21(1) AF. Salongo talked about them in the VAT Act, and Fiona also talked about them in the Excise Duty Act. So there are these incentives, they are similar, they are somewhat similar in nature, and in terms of the conditions that one needs to meet to qualify for them. They are available for taxpayers who are making investments that meet certain thresholds that and they are investing in particular sectors, primarily manufacturing, and those sectors are listed in the statute. So the thresholds are $10 million US for a foreigner, and $300,000 for a citizen, or $150,000 if the investment is US, if the investment is made up country. So the amendments made this year were to those incentives in the Stamp Duty Act. The incentive that the amendment made was reducing the requirement for use of locally produced raw materials in order to qualify for that incentive. Previously, the Stamp Duty Act, as all other acts do provide, all other acts still provide for 70%, use of at least 70% locally sourced raw materials subject to their availability. However, for the Stamp Duty Act this year, it is being amended, specifically for the Stamp Duty Act, it is being amended to 50% locally produced raw materials in order to qualify for those incentives. Then also for the minimum number of citizens who are employees, in order to qualify for these incentives, it is required that the taxpayer have a minimum number of employees and who are citizens. So previously the minimum requirement has been 70%. However, this has now been changed to 100 citizens. Then there's also an extension of the incentive to a manufacturer whose investment capital is at least $50 million United States dollars. So for this manufacturer, this is akin to the manufacturer that Salongo mentioned, whose requirement is $30 million US or $5 million US for a citizen. So for this particular manufacturer, you need not be investing in those particular sectors that are listed, the likes of agro-processing, creation of building materials, manufacture of tires, and there's a particular set of sectors listed. So you need not be investing in those sectors, but as long as you're investing $50 million US in manufacturing any item, you qualify for these incentives. The other conditions will, however, still apply. That is, the taxpayer, to qualify for these incentives, must be employing at least 70% citizens and must be using at least 70% locally sourced raw materials. Thank you very much.
Well, thank you very much, Solomon, for that. We have about 10 minutes to close this session. I'm going to try and go through, I'm going to read some questions that we should try and answer. Thereafter, we shall all have closing remarks to our dear listeners. Pascal asks, good morning all. Can I issue a tax invoice to an exempted organization? The answer to that is yes. You can issue a tax invoice to an exempted organization. URA has regulations that help in ensuring that the exempted organizations are refunded the VAT that they incur. So they will pay the VAT and get a refund. However, where you're making supplies to projects, I don't know if you have distinguished between an exempted organization and exempt supplies, but if you're making an exempt supply to, say, a project, you will not be required to charge VAT on such supplies. Winnie, is there a penalty for dealing with non-registered VAT suppliers? Sorry for that. Is there a penalty for dealing with non-registered VAT suppliers, but who are eligible for registration? No, there's no penalty. If you're dealing with someone who is not registered for VAT and it was their requirement or their mandate to be registered for VAT, the offense is not committed by you, the person dealing with them. The offense is by the person who is making supplies and is required to register for VAT. I'm quickly browsing through some of these questions. Where we're not able to give answers in this session, the chat will remain open and we shall type and exchange answers to some of the questions as may have come in. There are some questions that do not relate to what we have discussed, but I may still go ahead and read them. What happens to a taxpayer who is an employee and his or her employer does not pay or file payee returns on time? The responsibility to file an account for pay as you earn lies on the employer. So where that is breached, the employer is fully liable and shall be required to be penalized and and any penalties will be imposed on the employer and not the employee. Anonymous asks, I need you to elaborate on the applicability of the 75% expense allowance both to companies and individuals. I don't know if Solomon would like to expound on that. Go ahead.
Thank you very much, anonymous taxpayer. Regarding the 75%, it is indeed applicable both to individuals and to companies. Look, the tax on rental income tax is ring-fenced by the Income Tax Act. Section 5 is the one that caters for rental income tax. So Section 5.3 restricts individuals, what the deductions that individuals can get to those under Section 22(1)(c), and then also 22(1)(ca) for the mortgage interest. So 22(1)(c) is the one which has been amended to increase the deduction from 20% to 75%. So we know that from there that it is 75% is applicable to individuals. So Section 5, subsection 3 of the Income Tax Act says that for companies, they are able to claim all deductions available under the Income Tax Act. So Section 21(1)(c) has been amended to apply not just to individuals but to companies as well. The word individuals in that provision has been changed to persons, so it's applicable to all. So from there, it means that Section 75, rather the 75% is one of the deductions available to the company. However, like I said earlier, Section 5.3 says that the company can benefit from all other deductions available under the Act. That means that all other deductions available under the Act are also available to the company. So both individuals and companies are able to benefit from the 75% deduction. Thank you very much.
Thank you, Solomon, for that. The questions are quite many. Forgive us if we are unable to answer all of your questions. Some of you would like illustrations on how rental tax charges are imposed by URA and how the tax applies. As I said, these cannot be done as we are in a live session now. We shall keep the chat open. We shall try as much as possible to provide further information after the presentation. Yeah. But we can, as I have noted, most of the questions seem to relate to rental income and rental tax. We shall give you further guidance today.
If I may,
Go ahead.
yeah, regarding rental income tax, we're going to, one taxpayer has asked for illustrations. We're going to come up with illustrations that will show what the previous position was and what the current position is. As we can see, there seems to be a lot of confusion regarding that particular issue.
Okay.
These will be made available on the portal as well through the PCA.
Public and Corporate Affairs.
Yeah.
Okay, I think we are now at the end. We'd like to thank all of you for your participation and the questions that have come in. They are quite insightful, and we shall give you as many responses as we can today to give you clarity on some of the issues that you have pointed out. From myself, Brian, I'd like to thank you very much as a moderator for this. I'd like to call upon my colleagues to all make closing remarks and give you some tidbits on what you can do going forward. I'll start with my immediate right, Solomon Lukondo.
Thank you very much, Brian. To the taxpayers who have been attending, thank you very much for the attendance and for the questions. I hope this was beneficial to you. Regarding what I would say going forward, pay a bit of attention during the tax amendment process. It is open to the public. All the documents are made publicly available on the Parliament website or on the URA website. The invitations for public to comment on bills is open and outstanding. There are civil society organizations that are involved in that would represent what we would colloquially call the Muntu Wawansi, so they can represent your views. You can even submit your views as an individual. I would urge you to continue to try to be compliant, take an interest in amendments when they happen, and from there you would have hardly any problem with URA. Thank you very much.
Fiona?
Thank you very much, Brian. To you, our dear taxpayers, clients, we appreciate you as URA. Thank you for tuning in, for sparing your time to be with us today. And we appreciate you, and that's the reason as to why we are here today, to share with you what has changed in the law, so that you can be compliant and you would take note of the changes and prepare. And it's also in line with what my colleague Solomon has said. The tax policy amendments process is a lengthy process, and it starts about December, beginning of the year, each year. And we do have communications that go out. The bills are always gazetted, and the public is invited to come and make inputs into the tax policy amendments process. So this is to encourage you to participate in this process, because you as a taxpayer, you have an interest in what comes out in the law. The law is, what comes out is because of your input, our input, and the input of the general public. So we encourage you to take as much interest as possible in the tax policy process. And in case you need to consult us, you can consult URA, you can consult the Ministry of Finance, and so that your views are represented in the various policy amendments. And also just to encourage you that as URA, we also have your best interests at heart. In case you need to consult us in relation to these tax policy amendments, please feel free. We did provide our helplines earlier. You can contact us through those helplines in case you need further clarification. Some of you were inquiring about grammatic explanations on rental, and as Solomon indicated, we're going to provide that. But in case you need more information, please feel free to contact us. As URA, you can contact us on our toll lines, or you can contact us in our stations, and whichever line is most applicable for you. And lastly, I encourage you to continue fulfilling your obligations as a citizen, continue to pay your taxes as we develop Uganda together. Thank you.
Mr. Solomon?
Thank you very much for giving us this time and listen to us. Mine is a word of advice coming from a background of an accountant, that the problems of a taxpayer start with record keeping. Where you don't keep proper records, you're not going to pay the right tax, and that business is going to be affected. It's my belief that if everybody pays the right tax, or pays a fair tax, pays fairly what is due from him, then nobody will have a burden of tax, because each of us will have paid what is due from him. So, ladies and gentlemen, I urge you to partner with URA, and in partnering with URA, let us know those who are not paying taxes, because if you don't get them out, the burden now lies on you. Government is in the process of expanding the tax base, because taxes have to be collected. Now, as we expand the tax base, let us know those who are not complying and who should be complying. Let's pay what is fairly due from us. Let's keep records. Let's file returns in time. And if you're burdened, I know very well that tax is not on capital, tax is on profit. If you're not making any profit, then there's no reason that you be paying income tax. So to avoid those problems, keep records and file returns. Thank you very much.
Okay. Thank you to the panelists for your time. Thank you to our audience for your time. Thank you for logging in and paying attention to what we have to produce and share with you. Us as URA are very grateful for your support and patronage in paying your taxes, even in these trying periods where we are all going through a pandemic. URA is here to assist you whenever the need arises, to help you to be compliant. And even when you're not compliant, we are here to give you an ear to listen to your problems. We would like to commiserate with those who have lost loved ones during this pandemic. We all share in this pain as a nation.
A TIN is not mandatory when generating an e-invoice or receipt for a sale to final consumers.
Uganda Revenue Authority, developing Uganda together.
If the purchaser is a business that is not registered for tax, i.e. without a TIN, such a sale should be classified by the seller as a sale to a final consumer.
Uganda Revenue Authority, developing Uganda together.
No form of identification has been specified by URA as mandatory for issuance of an e-invoice or e-receipt. In case of a sale to a final consumer, the buyer is required to provide any of the following: name, contact, taxpayer identification number, TIN or national identification number.
Uganda Revenue Authority, developing Uganda together.
The Value-Added Tax Act 1996 requires that the buyer's details are indicated on a tax invoice required to be issued by every VAT-registered seller.
Uganda Revenue Authority, developing Uganda together.
The URA refund process is faster with EFRIS system. The refund claims are only allowed where e-receipts or e-invoices generated from an EFRIS system are used.
Uganda Revenue Authority, developing Uganda together.
A TIN is not mandatory when generating an e-invoice or receipt for a sale to final consumers.
Uganda Revenue Authority, developing Uganda together.
If the purchaser is a business that is not registered for tax, i.e. without a TIN, such a sale should be classified by the seller as a sale to a final consumer.
Uganda Revenue Authority, developing Uganda together.
No form of identification has been specified by URA as mandatory for issuance of an e-invoice or e-receipt. In case of a sale to a final consumer, the buyer is required to provide any of the following: name, contact, taxpayer identification number, TIN or National Identification Number.
Uganda Revenue Authority. Developing Uganda together.
The Value Added Tax Act 1996 requires that the buyer's details are indicated on a tax invoice required to be issued by every VAT-registered seller.
Uganda Revenue Authority. Developing Uganda together.
The URA refund process is faster with EFRIS system. The refund claims are only allowed where e-receipts or e-invoices generated from an EFRIS system are used.
Uganda Revenue Authority. Developing Uganda together.
A TIN is not mandatory when generating an e-invoice or receipt for a sale to final consumers.
Uganda Revenue Authority. Developing Uganda together.
If the purchaser is a business that is not registered for tax, i.e., without a TIN,